Looks like we're live.
We are live. I think we're running the B-roll. Right? Hey, everybody. Thanks for joining us again today on our live for five, live at five. I've got Taylor with me today. He is really the guy that runs everything in the backside of the mortgage company. So he's going to join us today and help us out with questions. So today we posted a video earlier in the week, and we're talking about mortgage insurance and how that helps us. And so just real quickly, mortgage insurance is really not such a bad thing. I know that a lot of people say, hey, you don't want mortgage insurance. However, if you don't have mortgage insurance, in most cases, you need 20% down. Prior to 1962, if you didn't have at least 20% down, you just didn't buy a house. It was just as that simple. And but after that, the federal government said we need our housing to get boosted up a little bit. So how do we solve that? And so they came up with mortgage insurance, and once they had mortgage insurance in place, so what mortgage insurance does is it's a mortgage, it's an insurance policy that protects the lender in case you stop making payments. And if you stop making payments, the lender is going to foreclose. But if you didn't put much money down, then the lender could take a loss on it. And so the mortgage insurance kicks in to make that lender whole. So that's what mortgage insurance does. And that now allows lenders to lend money with less than 20% down. So it's not really such a bad thing. And again, if you have questions, go ahead and drop them in the chat box, whether you're on Facebook or LinkedIn or wherever you're at, or just drop them in the chat box you here, and we'll see it. So there's actually Sydney and Butch is behind the scenes and watching those. So so there are some questions that come up all the time. I'm just curious if we have any questions, Sydney, just jump in at any time and we can answer those. So, Taylor, anything else that's come up that you've found on mortgage insurance?
A lot of times when people, so for example, I've got some clients that they did an FHA loan a year ago. They only had, just minimum down payments. Their scores were in a place that it made sense to do an FHA loan for a conventional loan, so like a 3% down type program. And already, even though their scores are still in about the same ballpark, we've talked to them and have looked at doing a refinance to get rid of that mortgage insurance already, just because the housing prices and values have skyrocketed so much that it's not how much you've paid, it's over time, if the value is up, then you can get rid of that. So I know a lot of times, like you said, a lot of times people don't want to get into that FHA product at the get-go because they don't want the mortgage insurance for the whole life of the loan. But that just shows that there's still some ways to do it and save, or end up saving them a lot of money. Even you don't have to wait years and years before it finally falls off. In a lot of cases, especially in the market that we're in, you can get rid of that pretty fast.
Yeah, so that brings up a question that comes up all the time is to how do you get rid of mortgage insurance? And just like Taylor said, that one of the ways is to refinance. But if you have a conventional loan, so if you have an FHA loan, if you put less than if you put 10% down or more, then your mortgage insurance can be removed after 11 years. If you put less than 10% down, then you're going to have that mortgage insurance for the life of the loan, which means you need to refinance to get out of that mortgage insurance. Now, that's not the same with conventional. If you have a conventional loan, if you have mortgage insurance, so less than 20% down, you likely have mortgage insurance. And to get rid of that, there's multiple ways that can happen. You can have, it'll drop off automatically once you hit 78% of the value of your original loan, your original value. Or if your values have skyrocketed, and because they skyrocketed, you can have a new appraisal done. And once you have that 20% equity, you can have that mortgage insurance removed, or you can refinance. So there's lots of ways to get rid of it on the conventional side.
Yeah.
Okay. So that's,
Oh, sorry. I was going to say, we've got a question. How is mortgage insurance paid?
You want to take that, Taylor?
Yeah. So typically, I mean, your traditional way that the mortgage insurance is paid. So for example, on an FHA loan, there's going to be an upfront mortgage insurance premium. So there's some, part of that mortgage insurance is going to show up in your closing costs, but then you'll have also a monthly amount that's just part of your payment. So it's not something that you go out and shop for, like, homeowners insurance and then pay, have the option to pay them directly. It's something that'll be part of the loan, and it's just going to be included in your payment each month.
So Taylor mentioned an upfront mortgage insurance on a government loan like an FHA. If you have a conventional, you don't have that. You don't have an upfront. You only have a monthly payment. So it's usually in your payment is where your mortgage insurance is paid. Although there are some other ways to pay mortgage insurance. You can pay it all up front and not have the monthly payment. So that's another option that a lot of people forget about, or your lender may not have offered that to you. So make sure to look at that option, because sometimes that's worth it, especially if you're going to be in the house for a long time, or you think you're going to be in the house for a long time. Paying it up front is not a bad way to go.
Yeah. And even checking with your accountant on some of that, because I know that mortgage insurance, in the past, it's been tax deductible. Don't quote me on that, because I'm not an accountant, but maybe talk to your accountant on that and figure out if there's any benefits to paying that up front as well.
Cool. Yeah. Sydney, do we have any other questions that's come in?
Yeah. So we have one. Does mortgage insurance pay for my mortgage if I'm out of work?
No. So at the beginning, we talked about what mortgage insurance is. So mortgage insurance really just protects the lender in case you stop making your payment and they foreclose on the house. It kicks in to make that lender whole, so that the lender doesn't take a haircut on selling your house. There is another mortgage insurance that you can get that protects you during if you're out of work, or if you pass away. You can get that kind of insurance, but that's usually through your homeowners or through your insurance company, like whoever is covering you on your homeowner's insurance or your car insurance. They usually have those policies available.
Right. So that's why with mortgage insurance, just like Ron said, it protects the investor for that. And so it really isn't a benefit, besides in the case that it gets you a lower payment. So with like an FHA, if your credit is a little bit lower, then an FHA loan is going to give you a better payment even with the mortgage insurance. So that's really the benefit of the mortgage insurance. However, once you have the home, or if you're in the position to choose between the two and they're pretty similar, we always try and, as long as it makes sense, we do a full analysis of the file, but as long as it makes sense, avoiding the mortgage insurance is good, because it doesn't benefit you directly in case of a loss or something like that.
Yeah. Just to qualify that, it doesn't benefit you except for it gets you into a home. You know, if you have less than
Right.
20% down and you're trying to do, you can't, just like I said earlier, is not prior to 1962 without having 20% down. You just couldn't buy a home. So it allows you to buy a home now.
Yep. Yeah.
Any more questions, Sydney?
Yeah. So is mortgage insurance expensive, and what determines how much you pay in mortgage insurance?
Well, that's actually that's a big question. So you want to start this one off, Taylor, or?
Yeah. So maybe how about this? I'll take the first part of that. You take the last
Okay.
part. Does that work?
All right.
Okay.
Yep. Fair enough.
I think
Go ahead.
the first part was how much is mortgage insurance? And Ron's going to touch on this a little bit later when he goes into what determines how much you pay. But how much it is, it depends. It looks at a lot of different things. However, from what we've seen, it can be hundreds of dollars a month, every single month. Depending on your loan size, it can be, really expensive. And so in that aspect, that's why like we've said a few times, if there's a way not to pay it, that's really the way that we like to go. Or even if you do have to start paying it, we make sure that we monitor that and get you out of it as quick as we can. It doesn't benefit Ron or I for you to have mortgage insurance, and so we would rather that you didn't, if at all possible. But Ron's going to go into what determines and go into more of those factors. But on another note of that, sometimes it isn't very much. Sometimes, let's say you have 15% down and you're doing a conventional loan, it might be, $30 a month or $20 a month, or, it's going to depend on some of that. So I'll let Ron go a little deeper into some of those factors.
Okay. So what determines how much your mortgage insurance is if you have a government loan, like an FHA loan, so an FHA loan will have a different factor than a conventional loan. Also, some of the factors are what's your credit score, how much of a down payment do you have, so it's those kind of factors that will determine how much your mortgage insurance is going to be per month. Like Taylor said, if you're getting a conventional loan and you have more money down, your mortgage insurance can be pretty inexpensive, or it could be pretty inexpensive to just buy it out and not have it at all. But if you have a low credit score and you're doing a government loan, your mortgage insurance can get a little bit pricey. So really what the best thing you can do is just call Taylor or I. You can see the number down there at the bottom, 801-628-7667, and just call one of us and we'll run some scenarios for you and tell you what the mortgage insurance is going to be for your scenario.
Yep. Yeah. And just to add on what Ron said, so the as far as it being expensive, all of those factors determine what the rate is, and then that rate goes into how big the house is. So if you're buying $100,000 house, I don't know if they exist anymore, but if you are, then it's going to be expensive each month, but maybe it's $100 each month, but compared to the rest of the payment, that's a lot. Whereas if you're buying a $500,000 house, that's where you're getting into the hundreds each month. So, just really, like Ron said, just call us. I mean, anyone on our team. So that number is the best to get us. But, even if for some reason you weren't to get Ron or I, our team's all trained on this. We make sure that they do a full analysis on the file and present multiple options to determine what's going to be best for you. They don't just say, this payment's lower than this one, so that one's the best to go with. They look at the closing costs. They look at, all of these factors and make sure that they take your goals into account before we make a decision on how to move forward. So we're more than happy to help you out with any questions.
Yeah, and we'll make that decision with you. So you're going to
Right.
have, we'll present some options, and then you make the decision. Is really what it comes down to.
Yep.
So is that it, Sydney? Do we have that's about it, right? Okay, she's giving me the thumbs up. Okay, so thanks for joining us at the live at 5, and we'll catch you again. If you need to call us, get a hold of us at 801-628-7667, and we'll catch you next week live at 5.